ladies and gentlemen. I hope you can smell what The Rock's cooking, because it's cooking a beat down. He's cooking a beat down right now. Stitch Fix getting the smacking of a lifetime after hours, down 15%. Now, to be fair, stock was up 8% in the normal trading session, so you have that going for it. But we're here to talk about this earnings report they just posted, and let's see why in the world is it down so hard, okay? I'd love to find out. So if you remember this was one of my focus stocks of the week for earnings. I'm very interested in it. They were predicting a revenue decrease year over year, which I was very much against. I was vehemently against that concept. I didn't think it was accurate. And you know what? Hey, I'm just telling you, I got my finger on the pulse of the nation. Regardless, though, Stitch Fix. Quarter 4 GAAP EPS of negative 44 cents, misses by 27 cents. Now, profitability, again, was going to be a big concern for me, so that's not a shocker. I am not at all shocked at what's regarding that profitability line. I'm not. And again, I think part of it's because of increased traffic, because guess what? Revenue, $443 million. Up 2.6% year over year, beats by 27 million. So again, they did post a positive growth as opposed to a decline as their guidance suggested. Active clients of 3.5 million, increased 9% year over year. That's the number you want to see. The consensus of 3.4. This is what you want to see. Client growth is key for this company, obviously. And net revenue per active client also rose 2% year over year, which is somewhat of a shocker. I kind of expected, obviously they didn't hit the consensus, but I'm surprised it actually rose, because again, with Stitch Fix, my estimation of it is, as they get more of the general consumer involved in their product, you're going to see a smaller net revenue per active client, in my opinion, as some people aren't going to buy nearly as much. They might stick with just the subscription plan and not purchase anything additional. So that's my opinion on the matter. As far as a little bit more data, Stitch Fix reports an 11% increase in revenue in quarter 4 off of increase in active clients. That's a dirty lie. The retailer just an adjusted EBITDA loss of $11.8 million versus $17.8 of a year ago. So again, it's an improvement on that aspect too. So you got to take that as you will. Oh gosh, but I take it as an improvement. I got nut in my throats, guys. I'm sorry, throats. I got nut in my throat. Please do not take that anywhere else. Don't record that. But it's just a fact. An update from them, obviously, on their direct buy program, which is, again, buying it straight from them as opposed to, going to a in-store physical retailer. We're particularly excited by the momentum of our direct buy offering. Again, that's my key thing. It's still in early days, but the ability to shop personalized items and outfits and our feed-based experience is clearly resonating with our clients. What's wrong with me? Our styling algorithms combined with input from our talented stylists, and network of nearly 10 years of shopping data are enabling clients to now shop via direct buy without even having purchased something from us in the past. That's incredible. Encouraged by its early success, we plan to expand the offering to give existing clients more reasons to engage with us, and to give new to Stitch Fix customers the opportunity to experience the magic of online personal styling through direct buy. And again, that is incredible. And there is one thing, if you have the opportunity, obviously, with this company, and look on their investor relations page and look at just I think they have just a generic 2020 presentation. It is incredible. They just posted this too. It is quite nice. It shows everything going on with this company and what they offer. from client data to how they personalize merchandise for you, from brand and price, measurements, everything. They know it all. They know it all. So, and the way they do it, they've got probability of purchase. So, again, as they get better as far as predicting it, the probability the person purchases it increases. So, again, the company's still in its infancy, to be frankly honest with you. There's a lot coming for this company, and that's why I like it. Stock going down is pretty good for me. I can't lie to you, but we got more data to look at, okay? Reported renewed surge in new clients in July and August. Quarter one is expected to grow mid to high single digits versus a consensus of 10.5. So again, that could be why not quite as robust of growth as they might have suspected. Offset by a lower subsequent volume, so lower volume expected, but more clients. Some of the benefit from new client growth moving into Q2. Given an uncertain environment, companies not providing full year guidance as expected. Revenue. However, revenue growth. Okay, to accelerate meaningfully. Revenue growth is expected to accelerate meaningfully in the second half of 2021 as the impact of stay-at-home orders subside. Let's go, baby. Now, we'll look obviously real quick at the earnings release. See this good data. I love data. I love it. And then we'll take a look at their shareholder letter as well for a little bit more data because we love it. Highlights, obviously, 11% increase year over year on an adjusted basis. Good stuff. Active clients up 9%. Net loss of $44.5 million. Not beautiful. We don't love it. We don't love to see it, but, could be worse. Could be worse. But not a good quarter for them. Obviously, we look at the balance sheet, too. See, we need to know a company not meeting these criteria. How are they able to survive? Is the balance sheet strong enough for them? So we take a look. Obviously, they're going to give me a year over year. Oh, yeah, baby. I love year over year. I didn't mean to get too excited there, but I did. Total current assets on this company, $466 million versus $482 million of a year ago. So small decrease there. Nothing crazy. Total assets in general of $769 million versus $616 million of a year ago. So honestly, good improvement there, and you see most of that just because of operating lease right of use assets. So nothing actually too incredible as far as that's concerned. But total current liabilities of $212 million versus $182. So those rose a little bit. But overall, total liabilities rose as well, 368 versus 220. You do see stockholder equity did rise just a little bit, 401 million versus 396. This is a balance sheet that I find quite exquisite. I got to be fair with you. I like the balance sheet. You've got twice as many or twice as much in terms of assets that you do in terms of liabilities. It just adds up to me. And I really see the potential in this company as we talk about the future and what they can offer. So I think at these levels, at the $26 range, I like it. And again, I'm still up on the position. Let me see if I can... real quick, I'll pull up my position on this bad boy. It's not weird at all, I promise. I'm not trying to sell you a stock I already own because I want it to go up. But, let's just say... I might be doing that. My cost basis is still $15.36, so I was up over 100% on this position. But you know what? Only 8 shares. I might consider picking up a few frickin' more now. I wish I had done it before. But again, if this holds into tomorrow down 16%, I'll be really intrigued. So, yeah, company's got a lot to offer. Please look at this PowerPoint presentation when you get a chance. But overall, the numbers look good as far as this is concerned. I get it, guidance was a little bit short. That's why the stock fell. Revenue was good, and EPS line wasn't as beautiful as you might expect. But I like what this company's offering. I mean, market cap of 3.2 billion off of annualized revenue of really last year, putting up around $2 billion. I mean, I can't complain. I can't complain about that valuation. It's cheap valuation, and a good balance sheet. I'm a buyer. Let's go. Hope you enjoyed this and you have a good one.